Good morning, everybody. Here we are, another Market Thunder. Lots has went on since last Friday's broadcast as we did a closing broadcast. We're continuing to work on the show format. We're going to basically go through a number of things today that will hopefully be helpful in understanding what's gone on with the markets in the last two sessions. Have been pretty amazing from that standpoint. Couple things, house cleaning. I want to make sure you guys sign up and follow us. That way, whenever we go live, if we decide there's some event going on that we want to broadcast, you'll get notified that we're live. Also, you can follow us on Twitter. We'll also be releasing that on Twitter as well. Let's go ahead and kick off on the markets. Overnight, we just saw the markets stabilize. We saw some weakness in Europe early in the session, just kind of catching up with what we did yesterday, and then they started to stabilize. This morning we saw the market continued lower, and there's a lot of pressure here, and I'm going to go over and talk a little bit about the market. So I'm going to go to a live market screen so that we can start taking a look at what's going on. The chart that you're seeing here right now is the S&P 500 futures, and this is a 1-minute graph. This is a graph that I use to look at short-term movement. I did a tweet about 30 minutes ago. The market had broken through the 1839.40 level. It went down to 1837.50, and it's just completely made a turnaround, and now we've got a mini reversal going on. The key resistance today, and I put this on the tweet that I did, was 1850.40, and the market's now trading 1851.47. So we're back above that. Because of the increase in volatility over the last couple of days, the next level resistance is not until 1856.35. So it's possible that this market's probably seen most of the upside. It could see a little more right now, but it's probably not going to get through this 1856.35 level. If it did, then that would signal that we're going to go into more of a consolidation phase. What I'd like to do is we're going to look at some different charts here, and I'm going to go over and we're going to look at what's happened in the last two sessions since I was able to talk to you, and even since I was able to do Monday's big commentary. We'll cover some of the elements that I was talking about at that point. I'm going to need to take something off here so it'll make it a little easier to see. Okay, you'll see that I'm going to bring up my whiteboard so you can see exactly where I'm focused on. There's a couple areas. If I'm going to draw a line through the middle of this action that we've seen, and you can see for the most part, this market since around mid-March has just been in a flat line, and there's been really nothing new going on other than we got a little spike out where we went up to this 1897 level that we saw on Friday very quickly. And then we saw the big reversal Friday, the follow-through yesterday. So it looks like we're probably completed the low this morning as we traded down to the 1837.50 level. You may recall, as a matter of fact, I'll draw these lines on here real quick so you can see this level down here is pretty much the bottom end of the support going all the way back into February, where this pattern has been unfolding from. And other than this little spike, we've been locked in this sideways pattern. So the market's been flatlined, really. There's days where it feels like there's things going on, but there really hasn't been much going on from a trending standpoint. These indicators down below, these are the PPMs. These are all in VPM. And you can see that we've seen a pretty good collapse of momentum over the last couple days. When we were looking at this on Friday, most of these indicators were still up, even though the market was down, ended up down on the session that day. And also, the week ended up positive, even though it felt pretty ugly on Friday. It wasn't as bad as it looked when you looked out at the weekly level. This bar that we're forming today, there's a little reversal forming. The key is going to be the high of yesterday. I'll bring up those numbers in a minute to discuss. But this pattern is still within that trading range. We want to get out of this trading range. We can't seem to get out of it. Other than that spike for about 2 sessions, we remained above the 1882 number. I harped on that number for nearly 2 weeks as a key number. That was the high end of the range. Well, we've fallen back into the range, and it looks like nothing's happened. And if you look at things from a fundamental standpoint, there really isn't anything new there either. The employment numbers weren't anything exciting. There were job creations. It really was about market sentiment, market expectations that happened, not so much about what any new change in the economy or anything. So we're somewhat stuck at this time until there's some new stimulus to come out. So as far as let's go to the next level, and let's go ahead up and look at the weekly graph just to kind of do a summary of what I was looking at on the weekend commentary. And what we've seen here is just more of the same. I'm going to point out a couple of things if you missed Friday's broadcast, but I think it's important to continue to show you where these key levels are and what's been happening. I discussed this on Friday, but it just keeps popping up. These spike bottoms that I'm drawing arrows on right now, those have been key places, and each time we've went up after a spike and stair-stepped this market higher, including this one that we had back in March. This was the 1734 level where the market spiked, and each one of these have continued to stair-step higher. So this pattern is basically continuing. The question is, do we get a spike here and yet another pattern that goes up? That's really what we're trying to figure out right now. From a trending standpoint, looking at VPM's database, other things of that sort, which it's really important to understand that we continue to be about 61-62% invested in the markets. And in spite of all this noise, and that's pretty much what we're dealing with here is noise, the trends, the number of trends that are out there are pretty substantial from the standpoint of what's going on with individual stocks and other elements. So going back to the live charts here, the momentum, you can see down below here, momentum is fading, and this is pretty typical. One of the concerns I have in this particular trend from a standpoint of the intermediate level is really understanding what's going on with some of the minute elements of this trend. So if we go down and look at the indicators down here below, the PPMs 1, 2, and 3 here, you'll see that momentum is declining. In the case of the short-term indicator, it's flat. It's declining down at this level, and then the longer term, which is based upon the 40-week moving average, which is very similar to the 200-day moving average, is also declining. But when it comes down to it, this trend is still alive. And I discussed this, I think, on Friday as well, is this trend we continue to see stay alive is based upon, you can see the 3 moving averages, which in the case of what I use is the 10, 21, 40. These are continuing to stay in a trending mode. They're not crossing over. So the 10 isn't crossing the 21 or the 40. And that all that tells us is that there's more of a flattening of the trend. And you can see areas where it's crossed before. You've managed to continue this upward trend. The big trend line is this green line here, which is the 40-week moving average, which, as I mentioned, is very similar to a 200-day moving average. I just don't use a 200-day. I use the 40-week instead. Seems to be a better it's worked better for me for nearly 25 years. I've been using this average. But you can see points where, as long as the momentum is stronger, this indicator down at the bottom here is what we're monitoring this from. So you can see as long as it stays above its center line and moving higher, this trend has continued. And we're just flatlined at this point. We're not really seeing any expansion. And then just a quick view of what's happened from a monthly standpoint, which is the next level. When we go to the monthly graph, now you're looking at back to about 1994 right now, and what we're seeing here is just a continuation of this big trend that's been unfolding, that started way back in the '09 recovery and then has continued to evolve. So these longer term trends obviously are not as sensitive to the day-to-day noise and the week-to-week noise that oftentimes is focused on through more of an emotional standpoint. So just like, if you notice, I'm going to box out an area here. This was the top back in 2008 that I put a box around. If you notice, these moving averages and everything started to roll over, and when it was at its widest point, we were getting close to the top here. And this is what we would look for the end of this particular sequence. And right now, I go back and look at where we are right now. You can see the moving averages are actually pretty much expanded as far as they go. So that means that we're probably nearing a top, but it doesn't mean, it means that there's a lot more work to be done here. For me, the key area on this graph is going to be last month's low is pretty important from a standpoint of the market trend. One of the things we've seen since a big reversal back in February is it's important that we don't make a lower low even on a monthly basis. The low last month was at 1834.44 level, so that's going to be a key level. This morning we traded as low as 37.50. So that in itself, matter of fact, 1837.49 was the low, to be exact. And so we were close to taking out that number. Had we taken out that number, this would set up a possibility for an outside reversal and a much larger decline. But as I continue to suggest, when we start looking at the longer term trends, this thing is not as dangerous as it feels based on Friday's activity. So I don't believe yet that we're at some major tipping point in the marketplace. It could change it over the next several weeks, but for the moment, I suspect that is not the case. Just to bring up the whiteboard again real quick, and what we're talking about here is this 10 period moving average or 10-week moving average, the 40 and the 21 are all advancing substantially. It's interesting that both the 21 and the 10 are exactly at 1.39, and what that means is that it's advancing, that moving average is advancing at 1.39% per month. Anything over 0.25 is a trend. So this is a very, very robust trend, and it's, I guess, understanding momentum is important, and at least how it works. It's sort of like a half pipe. If you took a ball one side and let it roll down, and each time it rolled, it would go not quite to the top, and then each side it would lose momentum until it stopped in the bottom. And that's what happens in momentum. Once you get momentum to a point, it will just stabilize. And that's this. I'm drawing an arrow through the PPMs down below, just a flat arrow. You can see what's happened is they hit their peak values. Some of in the case of 09 and 10, and then in the case of the longer term, all the way in 12. This is where the peak values happen, and now what's happened is we have a very stable trend that is really going to continue to drive this market for a while. And you can see the same thing happened back in 2003 after the big ramp up. We had these three levels, and then momentum stabilized. and it stabilized for, in the case of 2003 rally, we stabilized from 2004 all the way to 2006, actually into 7, before we started to see some weakness as we came in to the 07-08 high. And this, we're going to have the same thing happen this time, where we're going to stay stable. These moving averages are going to catch up. They will ultimately start to bleed off some of this. So these indicators over here on the far right will start to show more declines. What will happen on the moving averages up here is you will actually start to see this thing roll over. So let me clean up this thing a little bit. So the moving averages themselves will start to roll, and ultimately they'll turn down, and it'll look like everything else does, like it did over here in 2000, and this is in 2000. It did the same thing again in 2008. So the good news is we're not there yet. The bad news is we're getting closer to this scenario. And once this happens, whether or not we get one of these gigantic declines, I can't tell you yet, but there is a couple possibilities I want to discuss. And these are things I don't get a chance to do in commentary. It's just way too complex. So if we look at some of the longer term issues here, there's some pretty key levels to look at, and they're going to be this high that was back in 11, the initial high in 2010. These are going to be bands. If the market does decline, it would end up there. Now that's between the 1480 level, roughly, just approximate numbers, and all the way down into the 1300s. So if you start to look at what does that mean, that's, even though we would not make a new low like we did in 2002, we could see a 25 to 30% decline in this market and still have, on a long-term basis, a stair-stepping pattern going up. And whether that's what happens or the market collapses all the way back to the bottom of, the 2002-09 levels, which were similar. 09 was a little lower. That's yet to be seen. But for sure, once this top does come into play, we're going to at least see moves back into this levels. On the annual outlook, I discussed some of these possibilities. And from a long-term basis, there's still, I think, a lot to go. I think there's stability. So let's talk about what does that mean for individual stocks. And I think there's a misconception that's out there that somehow the indexes have to go up for stocks to go up. And if you look at the S&P 500, for example, it does not necessarily represent the entire market. It's a cap-weighted index. So there's a few stocks that are driving that index. There's a lot of other stocks that are not. For instance, in our Market 500 Premier that we have, the interesting thing about that, in 2000, it was able to actually make a profit, even though all the major stocks in the index drove the index down. It was able to rotate to the mid caps that were in the index and managing to squeak out a pretty good profit. Actually, it wasn't a squeak, it was about 11%. So while the market was down almost as much. And the realities of the stock market versus indexing, there's a lot of differences. And that's probably one of the elements that when you're utilizing individual stock portfolios, you're going to get much more dynamic. So there's a lot of stocks. The market could go sideways for 6 months, and there's a lot of stocks during that point in time that can move substantially higher in a stable environment. Let's equate that to more of a let me come back live here. Let's equate this to more of looking at what happens in the economy as well. The market has went up substantially. This is one of the biggest rallies that we've had in a long, long time, and it's historic. It's over 5 years now. Does that really mean that the economy had to be strong to do it? We've seen almost a flat economy, 1% to 2% growth. It's increased a little bit, But meanwhile, the stocks have been able to do very, very well. And it's the same thing with the indices. It does not have to continue to have this robust environment and the stock market going up 20% or 30% to be able to make money. What it does have you do is it forces you into doing individual stocks, looking, and stock selection is key. And when we start some of our other segments, we have a new studio we're installing this week. Once we get this thing really stable and we feel comfortable with this thing and we start to do our daily program, we're going to be going over all of the elements and how to build and construct and build some real quality equity portfolios. And we'll be going through all sorts of different strategies. But I think as this market unfolds, it's going to be more and more important to be able to focus on what's going on with individual stocks as much as indexing. Indexing is always boring. Dividend stocks, there's not a lot of money to be made in dividends other than dividends, and they also represent oftentimes a lot of risk. They don't actually mitigate some sort of risk like a lot of people think they do. So the realities of investing, especially with utilizing VPM, is being able to have a good rotation and screening methodologies and all those things. But it's important to understand that the markets are not connected to the point that stocks can't go up if the S&P or the Dow Jones isn't going up. Now, some of those as a reflection, but you look at, in the case of the Dow Jones, you're looking at 30 stocks. That's all there is there. In the case of the S&P, you're looking at about 50 stocks that are driving about 40% of the index. So let's go back and take a look at some other markets to take a look at. One of the things that's been happening a lot is let's go to interest rates. Let's go look at the 10-year. Let me change this increment to a daily graph here, just to get a short-term feel. Now this chart here is the daily 10-year, and you would be hard pressed trying to find somebody that didn't believe interest rates were going to go up. The Fed's taper going back to last fall and all of the elements that we've seen. And I'll go to a little longer term chart intermediate, but you can see once again the interest rates going this year have been flat, maybe down a little bit. You're not looking at anything that would be related to some sort of any big increase in yields. And I had talked about in the annual outlook that the expectation was for the first 2 quarters for probably lower yields, and then as we moved into the latter quarters, we would go start to see rates move higher. Let's go over to the intermediate charts and take a look at a couple of things here. Now you can see this a little bit better, and I think this is going to drive a couple things. And I joke, but my friend Bill Gross is telling everybody they should be in short treasuries, that the stock market's going to do better than the bond market, and meanwhile pretty much the opposite is happening. And of course he has the worst performing fund that's out there in the bond. I think he's in the lowest percentile that they can measure. And when you start to see, it's interesting from my viewpoint, if you turn on CNBC just for a few minutes a day, and there's people that are just great contrary indicators, and he's certainly been a good one for the last couple of years. He hasn't made a good move in a while. I think he was talking about the stock market going down right before it went up 30%. So, but the point of all this is that these rates have been very, very stable, and just once again drawing a line through here, you can see that we've been locked in around 270 plus or minus maybe 25, 30 basis points. This thing has gone absolutely nowhere. And from a momentum standpoint, there's a slight bias on a short term for it to remain stable, but there is a really good chance that we could see this thing move down one more step, maybe toward 250. But once again, this is a very stable environment, and this is what we've got a new Fed chairperson now. This is the appropriate way to talk. about that is this is really pretty typical of what the Fed wants to see. They want stability. They don't want anything to go up a lot, and they're running the show yet here, and market participants get it. Let's go one more level here, and let's take a look at the long-term 10-year. I might add, if you have anything you would like me to cover, go ahead and you can use a Twitter account. If you're following us on Twitter, you can go into the Ustream. There's as long as you've signed in, you can go in and send us a message there, or you can email support, and someone will get me the message if you have something that you're looking at there. So now what we're looking at is a longer term chart. So I am going to bring the spectrum of this a little bit better so we can get this goes all the way back now to 2000, and what you'll see here is we have seen an increase in yields, and there's a couple things that I think are important to understand about this market. Is what we're seeing here is, just as I talked about, here's the stability in yields, and this goes back to last year. That probably right here where you'll see these charts actually have, I'm not sure, I think this is version 1.2 VPM 1.2 logic on this chart, and we got a purchase here which suggests that interest rates are going to go up in this case, and it went up, and since that spike it's just been going in this range that I was talking about. A couple things that from a VPM standpoint, when I did the annual outlook, I did a circle around these dots. These are projections for yields at the time. They're 380, and we're looking at 440, maybe as high as 480. Those have been negated now, and these three little dots here, let me clean that up a little bit. These three dots here are projecting the new range, which is closer to the highest extreme around 340, maybe 350, with the minimum down around 314. And if you look at what we've done already, we've already more or less printed the lower level. We got into the low 3%, and then the market's backed off of there. But there's something I want to point out, and we talked about the trend indicators. So remember when it was really spread out, this was the trend. Here's the downtrend. It works the same way in a downtrend. We saw some crossovers, but did not cross over here. But now look what we're seeing. We're seeing a crossover by the 10. We're seeing all three averages inverting now, and sometime in the next 2 months, on the far right hand side where I put this last arrow, those two averages are going to cross, and that is the 40-month moving average and the 21. And the same patterns continue to emerge, just like and it's just basic looking at moving average using and understanding trend following. Those same things are happening, are beginning to happen. And what that tells us is that longer term, our rate's going to decline? Absolutely. And there'll probably be some new projections. The more interesting part of this is that the way that this price projection, depending how low we go, let's say we go as low as 230 or so, the next move up will be look something like this, and these moving averages will start to follow. We'll get a trend. Meanwhile, look at what's happening in these underlying indices, the PPMs. You see PPM2. You've got a very mixed picture here. So this is exactly how it should work. If you look at the middle arrow here, this middle indicator, just draw a flat line through it. That is actually pretty positive. What that tells you is that moving average, which happens to be the 21-month moving average, is moving up at 2.6% per month. And if you look down below here, you'll see that the very bottom indicator, it's only rising at 0.66. So there is a collision going to happen with these two moving averages. So this crossover is inevitable. One's going a lot faster than the other, and this suggests that we'll start to get this inversion of the moving averages, which tells us that there is likely to be a longer term trend toward higher interest rates. And if we were to, and back live here, and if we were to extrapolate out what was likely to happen in interest rates as they unfold and as the economy unfolds, if we looked at a complete normalization of yields right now, the 10-year would not be at 260. It'd be more like probably between 390 and 4.5 range. The 30-year would probably be a bit higher, probably in the 5, maybe 520. So it's important to understand that as these yields start to unfold, this is a longer term picture. So now we're talking about maybe 2015, 16, or 17. Let's do some other things here, and let's see what we can look at as far as let's talk some U.S. dollar here. And you're going to see similar patterns that I was just discussing. I'm going to take the U.S. dollar now and go to into a daily mode, and let me make this full screen. And you can see similar type things that we've seen in these other markets. And there's a lot of talk about Dow declining and some of the hype artists out there that are trying to make money off of this. And you'll see this as far from being real. What's happening with the U.S. dollar, we've seen a slight stair step lower, but not a lot. I'm trying to draw lines through what looks to be the average price ranges. So you're looking at a very stable dollar in spite of, we're still leading the world, whether some folks want us to or not. We're still leading the world from the standpoint of this being the reserve currency. The same elements are happening in these indicators, just drawing lines. We're looking at stable momentum. There's not up momentum, there's not down momentum. It's just sideways. So this has been range bound somewhere between around 70. This is the dollar index, somewhere between 79. Let's call it 79.50 to the 81 and a half level. This thing's been pegged here, and as long as that continues to be pegged, this gives the Fed the ability to manipulate and do things economically that they want to do. So we're looking at as a daily. So let's go to the intermediate, same as before. Intermediate, you can see this same trend going back to 2011. See my cursor moving around here. Same stabilization. Then we go to the longer term. This is probably a bit more interesting. I want to expand the view here. We're going to go out, see if I can go 40 years here. Yeah, this will give you a much better view of what's going on here. This goes all the way back to 1980. And a long-term view of the currency, you can see the devaluation of the dollar. And matter of fact, I've been quoted to say that when the markets were going up, the market and this dollar was going down, that you can't devaluate yourself into prosperity. And while these stable periods, I'm just drawing some so we can get some trending. If you pretty much look at what happened when the decline happened in 2005, the up arrow I'm drawing right now, those are actually a couple points where this went below what was norm, I guess, or it actually dipped down. Of course, that was the crisis. This was 2008, 2009, when the currency got a little lower. But the realities are, that when you're looking at this, you're really trying to determine the next major move. And but it would appear to me we're probably more likely to go up than anything else. One second, folks. Okay, great. Thanks for just a second here. Somebody did ask what the PPMs are measuring, how they measure things, and I'll cover that real quick here in just a few minutes after I finish the Dow analysis. So right now, the patterns that are unfolding are pretty typical. Very long periods. Currencies tend to move in 5 and 7 year blocks. They once they start a trend, they continue to go on for a lot further than people think. You see all types of central bank intervention, all types of things that are going on with manipulation or attempt to manipulate, but you really can't stop currency. It's the biggest commodity market on the planet is currency, and when it starts to move in a direction, it will just keep on going. So this is, you can see here, this is 1980, way over here, at a Dow index value of 80. So we've devalued by 50%. And when you look at this thing from a long-term standpoint, other than this little blip that we had way back in the 90s, in the mid-90s, matter of fact, this 94 on, this little blip here, this is when we had a balanced budget. Clinton was president. We did have a balanced budget. Didn't mean we didn't have a deficit. We were living within our means at that time. The dollar seemed to do really well. Rubin was the Treasury Secretary, which in my opinion is one of the best Treasury Secretaries that there's been since I've been in the markets at almost 35 years now. He executed a brilliant plan in changing how the markets were structured and got us to a much shorter term maturity on it, and that also helped get the dollar to move higher. But now, when I go and look at this thing, if we just take since the devaluation happened back in the early 80s, I guess this was during the Reagan years here, 80, 82 down, the dollar dropped by 50%. Other than that blip in 90, let's call it 96 to 2000, the currency's been about the same value all along. Now, what's going to make it appreciate again? Chances are this is about as low as it's going to go. So the next phase would be some sort of blip, maybe to mimic what went on. I'll just draw a box around this area here that went around this area right here. But the best way, I guess, to look at this is that we have a very stable currency. There's some fluctuations on a short term, but nothing that has been that would cause any dislocations in strategy from the Fed to what the government's doing. And this is, I guess, in the last 7 or 8 years since we've been building this debt, and we've got $1 trillion debt. That's really what's even then we've managed to stay very stable during this period of time. So let me answer the question real quick about the momentum indicators that BPM uses. Matter of fact, I'll just leave this full screen. It's interesting because most people tend to look at momentum on a daily close basis, and maybe they'll run a 10, 20, 40, some increment of time on momentum. What VPM is based on, this is understanding the PPM stand for price pressure momentum, and what they're telling me is what angle of attack that they're at. So I'm going to try to find a better chart here to look at this. As I looked at, this is not as good. Let's go over to S&P graph, which will give me a better little better view of the PPMs working. And what the PPMs are is they're measuring the downward pressure, the angle of attack. And what that means is back in 1984, 85, I did a study with a colleague of mine, and what we wanted to know is everybody's used moving averages forever as trending tools to understand directional movement, all that type of stuff. And they had to use crossover systems, all types of elements. What we decided to look into, which is important to understand, is what we did was we wanted to look at when was a moving average a valid trend and when wasn't it. So these indicators are measuring the percent change or the angle of attack. So the steeper the angle of attack, let me just draw a little triangle here. The steeper the angle, the more that the less likelihood that the market will decline below it. And if it does decline below it, it will stay below it on a closing basis. And it doesn't matter what the incremented chart is. You can see this red line coming through here where my cursor is. Even though it spiked below it, it managed to stay above it on a closing basis. I think there was, once it got to a certain point through this entire trend all the way to the top, even on these spikes, it managed to stay above it. When it started to close below it is when this turn started to happen. And you can see in the current market we're way beyond it. So we're at a very steep angle. As I mentioned earlier, we're at 1.4%. It's actually increased with this little rally that we've seen. And these indicators update real time. And it's increased slightly, and what tells us is that there is less than a 10% probability that the market will penetrate through this red line I just drew. There's virtually no possibility of that occurring. Now this is the long-term charts, and as this same scenario goes on each one, so I don't want to get into a really deep discussion of this, but what they're doing is measuring the angle of attack. I mentioned this 0.25 number. If it's up by 0.25 or greater, then the likelihood is only about 40% for a decline below that average. If it's greater than 0.25, 0.5 or even 1 or greater, then it will give you just virtually a certainty that the market's going to be able to stay above that line. And that's part of the philosophy that goes into the logic in VPM, is understanding where it's at in trend. And depending on the end of these trends, from a VPM modeling standpoint, we're not looking to buy the bottom, we're not looking to sell the top. We're trying to find a way to capture that middle 60-80% of a trend. And normally, if you go through and look, even if let's say we had a trade on and we got out and we got back in and we got out, if you look at the cumulative of those two trades, you'll see that it equals to 60 or greater in most circumstances, unless it's a very choppy trend that has a lot of volatility. A normal trend looking like this, you're not going to see that at all. You're going to see that stair-stepping move. You're going to see this type of configuration on the moving averages. Now, I'll take off this thing. I'm going to take this chart. We're going to go all the way down to a 60-minute graph. So what you're looking now is a 60-minute graph. The same characteristics, doesn't matter the length. I could go to a 1 minute, a 5 minute, a 60 minute. All of these characteristics always maintain themselves. So you can see, I'll draw a couple areas here, and I think this is, it's interesting to me, I guess, because it became my life's work 30 years ago when we started this research. And I think one of the key elements in being successful in the markets, making any type, your own analysis or anything, is being willing to find some fundamentals that work very well, and then understanding the characteristics of them rather than always trying to find something that is going to give you the holy grail. There is no such thing. What I spent 30 years in understanding is how moving averages move, how they react, what their percentages are, and we took that logic some almost 20 years ago now and put that into computer logic to look for these characteristics. And this is really key. So if you look at Go back to the whiteboard. If we look at what's happening on this trend, same scenarios as this is an hourly graph. So this was going back to Friday. So the first hour of trading was this bar here where we made the historical high. The next hour we saw a reversal. We saw the moving averages start to move down. We saw this downward slope and all of this starting to occur. And then we went down to the next logical place, which was the 40 period moving average. It stabilized there for a minute, but once it traded through there was nothing. And now all of a sudden, as we unfold over the next couple days, you see we're all the way back down to the bottom of the trading ranges. There was literally no support. But meanwhile, what's happening, you're seeing these moving averages happen. And look at what also is happening. You're getting the spreading out of this trend. So what's likely to happen is these moving averages are going to do just like they always do. You can see we're now trading above the 10-hour moving average. This thing is going to start to round out, and all of these things will meet over here. And we're talking about 2 days. There's 6 bars a day that are happening. So when I'm talking in commentary about the next, we should see a 2 to 3 day sideways pattern. Depending on what sets up in this pattern is going to tell how this thing's going to play out. So let me clean this up a little bit. So what's going to happen from a market standpoint is some sort of pattern, and then the key will be determining whether it goes down or if we continue some sort of recovery. And this is the art of technical analysis. I could actually put the VPM models on this, running on an hourly graph, and get signals on this. I've kept it clean just so it's easy to discuss. But I want you to look at the PPMs now. What are we seeing there? We're seeing them bottoming out. They've hit a peak value. They're starting to cross over their first and second derivatives and starting to show, in the case of the short term, this top arrow right here, that one's already made the move. You can see we're trading, once that happened, the market rebounded, traded back above the 10-period moving average, and now we're setting up the next pattern to determine how it's going to play out. Let's take one more quick look at something while we're talking about this stuff. And this is understanding how the mechanics of the markets. And so you see over here toward the middle of the screen, I'm drawing some arrows on these moving averages. The same thing happened here. The 10 turned up and sliced through the other 2 averages. Chances are that same thing's going to happen here. And what that's going to mean is that we're going to get a retracement rally, and depending on what happens here, tell us whether we're in the trading range, whether we're setting up a pattern to decline to the next level. I've been talking about the 1834 to 27 level. This was a similar discussion. It's like deja vu when we were back down here at these levels last time. Those are the same projections because the patterns are similar, because we've been locked in this sideways movement for so long now, almost 7 weeks actually right now. So once again, this is a 60-minute graph. Once you go to a daily graph, you see a similar pattern setting up, and those are things that are unfolding in the minor trends. So let's look at a couple of things here and come back live. And one of the things I want to discuss with you is it's important to understand that when you're looking at these markets and trying to figure out which way they're going to go, that's the beauty of what we help you do, which is identifying the underlying trends. The nice thing about with utilizing VPM, we've got the ability to watch as many symbols as we can put in the database. Currently, it's stabilized. It's been about the same for the last couple years now, around 18,400 symbols. And the beauty of that, of being able to watch the percent bullish, all the other elements that are happening, really make it a lot easier to figure out internally what's going on with the trends even further. So the percent bullish tells me how many stocks are long. They never get to 100%. The highest level that we saw was back in 2009, when everything was mispriced, and then we saw the markets go completely from mispriced to reevaluation to more of a, I guess, a fully valued pattern from the standpoint of where they were. So we were trading at almost 2 standard deviations off of book value at one stage. It was about 1.5, and then we went back to book value, and that was the rally in 2009 that we saw from 600 all the way back to 1,000 on the Dow, on the S&P. So that what we're looking at when we're trying to figure out these trends, and when we look at the bullish percent, gives a really good idea on how this thing is going to play out, because there's a couple elements that I feel that VPM brings into an analysis viewpoint that very few other things I've seen in the 35 years I've been working to understand things in a more in-depth pattern. So you could look at how many things are above a 200 period moving average. You can look at all these different things. Companies like Dorsey Wright tell you how many stocks are over and whether it's over, but what they don't tell you, and what we can do with VPM, is we can tell you about the expectation of how these things actually work. So what I want to do here, I'm gonna bring us into VPM real quick, and this is going to be, I think this will be a good thing to look at, because this bullish percent is a good pattern. While I'm doing this, I'm going to set this up on the other screen. Let me bring it live here. Let's go back to market screen, and while I'm setting this up, you can look at the short-term activity that's been happening. And while I've been talking, you can see we're trading right now the futures on the far left. You can see the bid and ask, and in the middle there, that is the actual number of contracts and trades that are going on in real-time mode. So let's go ahead and bring up VPM here. So I'm going to make this a bit larger so you can see it better. And what I want to look at here is the all stats page. And this is what I'm talking about with this bullish percent, that I think this is really important to understand from a standpoint of what we can do that you can't see this type of visibility anyway. So we have 18,342 symbols that we're looking at right now. 61.56% of them are bullish. The percent long right now is really, or the number longs are 11,292. So what that tells us, there's 11,292 trades that are trending, that VPM sees some sort of trend. The key stats that I think are really important to look at here, I'll make these a little bigger so we can see them, is these numbers over here were the average days long. So we have them broken down on daily, weekly, the whole spectrum of what the database has to offer. We also have them optimized daily, optimized weekly. So let's look at optimized weekly right now. You can see the average days long in all of our models are 185 days holding. The current duration is 72, and the percent of that duration filled is 37%. So of all of those trades that we have out there, those 11,000 trades that are on that list, are only 37% has been realized. And the interesting thing is that number never gets to 100%. It will get into the upper 70, 74, 75 is a very mature rally. And since we've seen some rotation, the new trades that are coming in bring this number down as well. So it never gets to 100%. It can't. The average profit that's made is 36.47%. This is on all 18,000 symbols and their profiles. The current average profit is actually 10%, and the profit percent filled is 28%. So right now, as we look at the marketplace, even though we've got 61% long, we're still very early stages of this particular expectation of the trends that VPM's identified. And you can break these down by weekly 1, 2, and 3, 2, but these are important stats. And what it does is gives me the confidence for being able to walk forward the database and give you an idea of what's likely to happen in the trends. And this is why it's also very, very important to be able to stay with these trades and not get in and intervene into the process. I come back live now, and this will be our final 5 minutes of the show. We did some educational stuff. We talked a lot about the markets. Once our plan is that we're going to do another show on Friday, which will be a summary of what's happened for the week. But we're hoping that sometime in the next week, no more than the following week, that we will be doing these every day, and there'll be a different format. We'll start to really focus in on different segments. Today I kind of flowed in the way I want to. We cover the markets in detail. We'll go through interest rates, maybe the Dow. We did not go through gold. On Friday, I will remember to go through gold, and we'll talk about some of the commodity aspects of what's going on. I haven't done that yet. That might be something to discuss. We may be focused more on the markets depending on what's going on, the stock market, depending on what's happened. But the bottom line is we'll cover whatever's necessary, and this gives me a format to really talk to you about a lot of different things. And understanding what I was just talking about, the bullish percent, to me is ultimate in understanding what we are doing in the marketplace and how to understand the rotation of what's happening in the markets. And right now, 62% is a pretty good number. Normally we'll get to 68, maybe 74%. In 2009 we actually got to 92, but that was because almost every stock had been mispriced and was so underpriced that when the markets turned around and everybody realized that the world wasn't coming to an end and that these companies were not going to fail, then they had to reevaluate them. So a lot of really strong trends developed early on in 2009, and that caused the database to that was actually a historic event. It was historical both ways. In 2008 and early 2009, we got down to 7% of the symbols being long. And then we went literally from the worst to the best in about a 5-month period. And that set the tone. If you remember me talking about the momentum, that's what we've seen in 2009. This momentum continues to build, flatten, rebuild, and we continue to see this market go up. And we've been, as I said, a 5-year trend, and this is one of the bigger trends that we've certainly seen. So in closing, we really would ask you folks to make sure that you sign up on the Ustream. So follow us on Ustream, follow us on Twitter, so you know when we're doing shows. If things get crazy in the markets, I'm gonna turn this on and talk to you folks. I have an eye on these markets at all times. Sometimes I do travel, but for the most part, I'm here probably 92% of the time, if not more. So we're always on this thing. We've got our eye on this. So I want to thank you all for participating today. Please send us some feedback. Tell us what you'd like, what you didn't like, so we can get good at doing this, because this is our platform to be able to talk to a lot of you. So I feel like I've had a lot of advisors had the opportunity to have you guys in my office today and really discuss some pretty detailed items. So after the show, if you want to send us some emails, please do. We really appreciate you coming on today, and we'll talk to you on Friday. Thanks for coming.